Okay, welcome to the ACEP webinar. Today, the subject is tax effective strategies for wealth accumulation. For some of you who are getting this recording, we apologize for the interruption we had with the internet earlier today, but now you've got the full presentation coming. I'm Bill McDonald. I'm the president, CEO of My Financial Coach. We're a partner with ACEP in providing financial planning services to its members. We put this partnership together so that we could bring financial education to its members so that you can make better decisions in the things that you're doing. Our CFPs are all salaried employees. They're unbiased and unconflicted. Unconflicted means we're not there to sell you product or a service. So you might want to hit on the icon at the end of this presentation and take a look at the benefits being offered to its members. Now, I spoke about a year ago in Philadelphia to your group, and in the audience, we had about 70% of you were 1099 independent contractors. And in that mix, some of you were working under W-2, and at the same time, you had your own entity structure where you were a 1099. We had a percentage of you were W-2 employees, and about 10% of the final were residents. Now, for residents, we do have a special program with ACEP. Again, you can get the details on the last slide at the end of this presentation and find out more about the financial planning service. Again, we're unbiased and unconflicted. We provide comprehensive financial planning in a subscription model, fee only, and many physicians have found this very, very valuable. So today I want to talk about these tax effective strategies for wealth accumulation. So you may be earning a comfortable living today. Unfortunately, if you're a high earner, without a solid strategy, taxes will typically take about 30 to 50% of your pay. Now, we're talking about federal taxes, state taxes, property taxes, investment earning taxes. It takes a big bite out of your earnings. Now, if you're new in your practice, new in your profession, you're going to get there someday. So building a strategy early is going to be important. Revolving debt can zap another third of your income too. So it can be very difficult to get ahead regardless of how much money you earn. I know a lot of you feel like I'm earning a lot of money. I don't seem to be saving a lot of money at the end. And the big bite has been taxes, or maybe you're paying down your student debt, etc. With only the remaining 1/3 to work with to pay your daily expenses and save for retirement investments, obviously it becomes quite challenging. So there's no easy fix to putting more spendable cash in your pocket. Taking on additional patients to earn more wages could actually make things worse from a tax standpoint. So today we're going to talk about strategies. It takes a little work, but you're going to be able to maximize your deductions, and you're going to be able to put more money in your pocket. For most medical professionals, it's implementing a tax planning strategy that lowers or even eliminates your taxes. Strategies that can lower your taxable income, reduce your overall tax rate, and utilize available tax deductions and credits. Now, much to my surprise, in talking to our CFPs, they told me that about 90% of the physicians we work with and working with their CPAs are only taking the standard deductions. They're not actually itemizing their expenses and deductions and maybe missing out on a lot of strategies. That's why I think if you take a look at most CPAs and tax planners are looking in the rear view mirror rather than through the windshield. Even in my own case, my CPA about this time of the year is contacting me, collecting all of my 1099 forms, getting all my expenses in line, and he's about to tell me how much tax I need to add to what I paid in 2023 and how much estimated tax I need to put away next year. Fortunately, because of my background, I've worked in the executive benefit and compensation area for a number of decades and have a background in tax strategies. I'm able to be more proactive to go back to him with ideas on how to reduce my overall taxes. I'm going to talk about some of those today. So you need to be making smart year-round decisions rather than when you're just completing your annual tax return. You're there now around April 15th, completing your return. You're searching for ways of lowering your tax liability. You should be thinking about this now throughout 2024 for next year. And if you haven't filed your tax return for 2023 yet, and you file an extension, there are plenty of opportunities we're going to talk about today that you could actually take advantage of for 2023. So doing proper planning can significantly reduce your tax liability and ultimately put more money back in your pocket. Now, as I mentioned, a number of you are 1099 independent contractors, and you may be there structuring your own entities, etc. So just like choosing the best plan of care for a patient, deciding on the right business entity can impact both your short-term and long-term financial results. Now, you W-2 employees, I've got some ideas for you coming along, but if you're a 1099 independent contractor or self-employed, having the right business structure is critical. The structure can determine how much money you can put in your pocket. Now, there's a number of different entity structures out there, from a sole proprietor to a partnership to a limited liability corporation to a C Corp to S Corps. I'm going to focus today more on LLCs and subchapter S corporation because that has the biggest impact on physicians. I personally have a number of LLCs in line, and that's why I'm able to reduce my tax liability each year. So let's start with the LLC and talk about the pros and cons. So the pros are you got low filing costs and less paperwork than other business entities. The most important part is you got that limited liability. So if you got sued, people are suing your LLC, which helps to protect your personal assets. You got flexibility to be taxed either as a sole proprietor, a partnership, or a corporation. So working with your tax advisor, you need to look at those different scenarios to see what best fits you. The business can be small, just one member, or large with a number of different members. Probably here, you're probably talking about yourself if you're a 1099, or if you're in practice, maybe just a handful of owners. On the con side, income is paid out as distributions versus wages. So you've got, self-employment tax and other things to deal with. Depending on the state you're in, you have high renewal fees, again, depending on what state you're in. As an example, I have an LLC over in California, and they charge $800 a year, whether you're making a profit or not making a profit. So you need to check those filing fees by state, and maybe even working with your advisor, trying to figure out what state makes the most sense for you. And finally, having an LLC may be more difficult to raise capital versus a partnership or corporation, although I don't think it should be a major problem for what you're all trying to do with your LLC. Now, when we take a look at the pros and cons of using a subchapter S corporation, we have the same asset liability protection as an advantage. It's a pass-through entity for tax purposes, and there's no self-employment tax on profits above wages. And that's the key right there. So working with a good tax advisor, you're able to set for IRS purposes a reasonable compensation level. And then anything else that's being paid to you should be distributions. So you're going to save on FICA tax as an example. Now, remember, if you're running your own corporation, even though you're a physician and a professional in that career, you're also performing other duties. So again, working with a good tax advisor, they can break down the duties that you have running the company and come up with what the IRS calls reasonable compensation. And again, working with a tax advisor who works with many physicians, they pretty much got that area nailed. And finally, easy transition of ownership if you ever to sell your practice, et cetera. So on the con side, the formation process can be tricky without assistance from a tax professional. And I would go through the pros and cons with LLC and S Corp with that professional. Restrictions on the company's stock shares is another disadvantage, the number of shareholders you can have and so forth, and potential tax penalties if mistakes are made on reporting. And that could be true with even as an individual. If you're not filing your returns properly, you could have obviously some issues. So as we go through this, there's going to be a number of questions. And since we're not doing this live today, at the end of this presentation, you'll have my contact information. Write down some questions as we go along, and you can fire those questions off to me, and myself or my team would be happy to answer them. So how to create more cash flow from money you've already made. So you're making a good income today. So one of the things you can do is income shifting. If you're running your own LLC or S corporations, you can put your children, your spouse, and so forth on the payroll. As a 1099 independent contractor, there are more items to deduct versus a W-2. And again, don't just take the standard deductions, take a look at all the itemized deductions you can take and do that assessment to determine how you can lower your tax, obviously putting more money in your pocket. If you own any equipment, you might think about owning that equipment at an individual level and doing a sales leaseback to your LLC or S Corp. If you're earning money throughout the year and you get to the end of the year, there are ways having a corporate structure where you can move money from taxable year to minimize your taxes in the current year. And then you have ordinary and necessary business expenses. I'm in the process of finalizing an ebook with a lot of examples that you can take advantage of. And again, you can through that contact information, shoot me an email and say, I'd love to get a copy of the ebook when it's completed, but I think it could be really, really helpful. So let's go through navigating and understanding tax implications. And here, if you're a W-2 employee, there's a lot of things you can be doing. And obviously running your own organization, I'm going to be telling you what the differences are. So let's talk about how people save for retirement. How do we all save for retirement? I'm going to use an example here of an individual who earns a good income, is say age 45, which it really doesn't matter. I'm going to talk about, when you're starting off, what you should be doing. And I'm just going to call this individual, to have a little fun here, Henry. Henry stands for high earner, not rich yet. But during my whole process here, we're going to make Henry rich by coming up with tax strategies for wealth accumulation. So the first thing about saving money for retirement, most people go to the obvious first bucket, which I call the tax deferred bucket. So this is where you put money into a 401k plan. So if you're an employee of a company, you might want to take advantage of that 401k, especially if they're matching your contribution. If you're working for a nonprofit organization, it's going to be called a 403b, but has the same limits. So in 2024, you can put away $23,000. If you're over 50, you can put away $30,500, goes right into this tax deferred bucket, comes right off the top without income taxes. Now, it's interesting, when my daughter took her first job as a W-2 employee, she asked me, should I put money in the 401k plan? And I asked if the employer was matching. He said yes, 50 cents on the dollar up to 6%, which is kind of a normal match. I said, think about that. How long do you have to stay there in order to get that money? She said 3 years. I said, so if you think about your contribution with a 50% match, you're getting a 50% return on your money before it goes into the investment. All you have to do is stay 3 years. If you leave early, you're going to get the money that you put into the bucket. And you can obviously roll it over to an IRA plan or another 401k plan. Now, if you're self-employed, you might look at a SEP, self-employment employee plan. You can look at an IRA. But if you have an entity structure and you're self-employed, you're a 1099, you have your own entity that we talked about, you can do a solo 401k plan. That's putting in your contribution plus your profit sharing from your organization. You can get that deduction up to $69,000. And if you're over 50, you can get it up to $76,500. Now, take a look at these new solo 401k plans under the Secured Act, because the expense loads and fees are very, very low if you use what they call a PEP plan. And a PEP plan can take a lot of the cost out of setting up a solo 401k. So here's what most people start off with. And if you're running your own entity and you're making a lot of money, you can then set up another tax-deferred bucket called a cash balance pension plan. And contributions going into this plan can be as high as $480,000 a year. Now, it's all age-based. And in my ebook coming out, I've got a table there where you can take a look at your age and the amount of deductions you can take. So a cash balance plan is like a defined benefit plan. So actuarially, we're targeting a benefit in the future, but we're going to make annual contributions plus investment earnings to get to that target. It's a device that a number of successful physicians are using to tax shelter a lot of money towards their retirement income. So as we talked about so far, this is where a lot of people are with tax deductions going into what I call qualified pension plans or tax deferred buckets. So now what's happening is before we can do anything else, there's a major intervention that's happening here, and it's called the IRS. Because the IRS, before you can do anything else, is going to withhold federal taxes. Depending on where you live, your state is going to take state income taxes. They're going to take what we call SALT taxes, which is a state and local tax, your property tax. And you're going to get hit with taxes before you can save the next dollar. Now, if you all remember Chris Rock, before he got slapped by Will Smith, he said, you don't pay taxes, they take taxes. And he's right. If you put the words together, the IRS, it stands for theirs. So the IRS is there to take as many dollars away as they can in taxes. However, with a good tax planning strategy, there are ways of getting those deductions, getting those tax credits, putting money into qualified pension plans to reduce your overall tax liability. So for most of us, after we pay our taxes and we've got after-tax monies and we still want to accumulate wealth, we're going to put it in what we call a taxable bucket. This could be a brokerage account with an advisor, whoever that might be. Now, you notice that this bucket is a lot larger than the tax-deferred bucket because there's lots of investment options and there's no government limit on how much you can put into the bucket. Now, there could be things like real estate, stocks and bonds, hedge funds, all kinds of investments are going into this taxable bucket. But there's one little annoying factor here, and you'll notice the spigot out of the left-hand side of the bucket called taxes. So on your investment earnings, you may be paying taxes on what they call realized gains. When you sell an asset off out of this bucket, you're either going to pay capital gains tax if you've held it on a long-term basis over a year or short-term, or you're going to pay ordinary income on interest earnings and so forth. So taxes are leaking out of this bucket, and what you want to be is really efficient in putting the bucket together. Now, at the end of the year, about this time, actually probably at the end of December, my advisor in the past used to call me and say, okay, let's take a look at all the losses that you've had throughout the year, and let's look at the gains you have, and let's sell those losses to help offset your gains, called tax harvesting. It's the wrong time of the year to do it. If you really want to make this portfolio efficient, you should be monitoring this every single month throughout the year. So if I have a large gain in January and I have tax losses in January, I might want to maximize my returns by looking at those. And there are a lot of firms that we work with that have technology that can actually track this throughout the year for you. So don't think about that tax harvesting only at the end of the year. Think about it throughout the year. So for Henry, this is what most people have done so far, but then someone comes along and introduces another tax deferred bucket called an annuity. Now, a lot of people are using annuities, but they are only good for the right situation. And you really should get an advisor to help you determine if an annuity is a good fit. And don't get the advisor who's selling you the annuity. Get a third party who really understands annuities that can show you the pros and cons and maybe the structure, and then bring some transparency to the annuity, because the load structures are quite different with annuities. So here we are with our wealth accumulation going towards retirement. And what's happening is we're taking a look now at taxes that are coming out on above. And I mentioned that you're getting federal taxes, state taxes, Social Security taxes, and Medicare taxes. And then we've got some taxes coming out of this bucket. In addition to money coming out of the bucket, if you're a high earner, there's a thing called the ACA, Affordable Cares Act, that's the Obamacare Act that went into play. And they're going to tax on investment earnings from the bucket for people earning over a threshold, another 3.8% on your taxable bucket here. Now, if you've got those same assets sitting up in the tax deferred buckets, there's no ACA tax on those. However, a big factor here is this SALT tax. Again, state and local tax. And we remember through legislation a few years ago, they capped your property tax. So if you were living in a high income tax state and had a $20,000 or $30,000 tax bill, property tax, today you can only deduct 10. Now, those states that have the high tax have actually come up with a strategy where you can actually use an LLC structure to get the deduction over the cap. So it's a tax strategy, again, working with a good tax advisor, you can take a look at. But let's take a look at this SALT tax and what the impact of it is. So as you can see from this map over on the left-hand side, California has a 13.3% state income tax. So if you're living in California and you're earning money in California, you're not only paying federal tax, but you're also paying 13.3. If you go down to the gray states, Nevada, Texas, and so forth, they don't have a state income tax. So I worked with a lot of clients in my career, working with a number of major corporation executives, where they accumulated money in retirement strategies in states like New York or California. So they tax deferred money. And then when they retired, they picked a location to retire in. And there's actually a tax provision that even a lot of CPAs don't know about, called the source tax provision, that allows you, when you take money out of a retirement plan or any type of deferred comp plan for a period of 10 years or longer, you can avoid paying the state you deferred it. So a great little strategy here is you tax deferred money in California and you move over there to Nevada when you retire. You take your money 10 years or longer from that retirement strategy, and you never have to pay the state of California that 13.3. Years ago, I had a client that had a sizable amount accumulated in his deferred comp plan. And he already elected to take it over 15 years, which already met the 10-year rule. And he was thinking about moving to Nevada in retirement. And I was being a little facetious at the time. I said, you're moving on the right-hand side of the lake, right? And he said, oh no, I'm actually buying a home at Lake Tahoe in the California side. I said, why? Is the fishing better there, or you have relatives there? He said, no, the homes are actually cheaper on the California side than they are on the Nevada side. I said, you know, you may be able to buy that house on the Nevada side with the tax savings from California. All you need to do is become a resident for 6 months or longer in Nevada. And as you take distribution from this plan, you don't have to pay California tax. He said, are you sure? I said, I'm sure, but let's get your CPA on the line. Make a long story short here, he called me from the porch of a house he and his wife wanted to buy. And he said, are you certain? So again, we got the CPA, got in line, and he was able to buy that home based on the tax savings from California. I have a good colleague and an investor, actually, a famous economist, Dr. Arthur Laffer, who moved from California to Tennessee and did the same thing, had a large gain and was able to maximize it by saving taxes. So you have to look at where you live in retirement for taxes and how you can use some of these strategies of accumulating and taking distribution. But as I mentioned, California has a high income tax. Texas, in this example, has a low income tax. But we talked about the SALT tax. This is the property tax. So as you take a look at this map, a rank of 1 is the best, meaning the lowest tax. This is property tax, and 50 is the highest. So if we go back to our friends in California, they're 14th. And if you take a look at Texas, they're 36th. So I have a son that lives in Texas, and he pays no state income tax, and he has a home probably worth about $600,000, and he pays $18,000 a year in property tax. Now, a lot of states have a provision, once you retire, they freeze the tax at that level. He's still young and growing his career, so every year his tax keeps going up. If he had a $600,000 home in California, if you could ever find one, his tax would be about 40% of what it is in Texas. So they're going to get you one way or the other, but you need to take a look at what you're paying in these taxes and how you can take those deductions over the SALT tax limits if you're paying more than $10,000. And you may want to think really about where you're going to retire and what those taxes are going to look like in retirement. So going through our example of Henry here, who's accumulated money in a couple tax deferred buckets, he's got his taxable account, he's maximizing his returns. And we've got this line down below here. Now this line represents the day that Henry is about to retire. So everything above that line is the accumulation phase in life, and everything below that line is the distribution phase in life. So it really doesn't matter what you're worth above the line. What matters is what you're worth below the line. So as we mentioned, now that Henry is thinking about retiring, his advisors have said to him, look, Henry, you've done quite well here. You've got a lot of money sitting in your tax deferred buckets. You've done well in real estate and other investments. You've worked hard your entire life. Maybe you ought to relax a little bit and maybe retire here at age 55. Well, his advisor forgot to tell him about this thing called age 59 and a half that the IRS has. What the IRS is saying is if you take any money from these tax deferred buckets before the age of 59 and a half, you must pay a 10% penalty on top of the taxes. So if that was Henry's goal all along, he should have thought about diversifying a little more away from just tax deferred buckets. So, you know, that's one thing in planning. When you go back to your objectives, you know, what is it that you're looking to accomplish, and when do you want to retire, and what assets are we going to use, et cetera. So now Henry hits the ripe old age of 62, and he and his spouse now qualify for Social Security. They go to their advisor and they start to look at the payments that they're receiving from Social Security. And in most cases, people think most of that money has got to be tax-free. But based on this little thing up above called AGI, adjusted gross income, you could be taxed as much as 85% on the Social Security benefit. Now, we put in money our entire life in this tax-deferred bucket called Social Security, but now the government is going to tax a good portion of that based on the earnings that we have. So one of the critical things in retirement, and a lot of people that I work with that are retired, they want to manage their adjusted gross income in retirement, because there's another factor. When Henry hits the ripe old age of 65, he's qualifying for Medicare. So he and his spouse go to this website, medicare.gov, and they look at how much they're going to have to pay for Medicare, for this Part B of Medicare. It's all based on how much money you earn. So if Henry is earning on a joint return $380 to $700 a year, he's paying $559 a month in Medicare payments. Now, keep in mind, for a lot of you who are a lot younger than hitting Medicare age today, what is this going to look like 10, 15, 20 years in the future? So the important part here, the message here, is to adjust, to get your arms around your adjusted gross income, because the higher your adjusted gross income in retirement, the more you're going to pay for Medicare. So a lot of people are paying a lot of money. Good portion of Social Security check is going towards Medicare Part B. So Henry's at a position now where he's all slouched down on the couch thinking, okay, so what should I be doing? How do I minimize some of these taxes? So I put a lot of money into tax deferred buckets. But when I really look back at it, all I did was really kick the can down the road, because all of these accumulations someday are going to be paid out, and I might be in a higher income tax bracket. And you've just told me that Medicare and my Social Security is going to be impacted by that. What else can I be doing? So Henry could be putting a bucket together early in life called the tax advantage bucket. What's unique about the tax advantage bucket is after tax dollars go into it, but as you can see, that spigot goes below the line and it's non-taxable income at retirement. So what goes into this bucket? You can put money away today in a health savings account. So you can get a little over $8,000 a year tax deductible that goes into a health savings account. You can use it to offset medical expenses and bring that thing year after year after year all the way up to retirement. When you get into retirement, you can actually use it as a tax-free offset against Part B and Part D of Medicare. It's one of the greatest tax shelters out there that is probably misunderstood. I talked to the chief financial officer of a major hospital recently, and he told me that he was not taking advantage of the health savings account. He had a low deductible medical plan, and he had very little in medical expenses. And I said, why? He said, because a health savings account is a use it or lose it benefit. If I don't use what I put in, the 8,000 plus this year for the family, I lose it. I go, no, that's not true. It rolls over every year. This is your bucket. You can diversify your investment strategies inside the bucket, and you can take this thing all the way to retirement. Another strategy is a lot of people are looking at their tax situation throughout the year, and they're converting some of their tax deferred buckets into Roth plans. They're using backdoor Roths, and they're using other strategies to convert the income over so that in the future it becomes tax free. If you've not learned anything from this bucket so far, remember the words non-reportable income. Because when you go back to Social Security and Medicare, this is non-reportable income. When you go back to a number of other offsets, it's non-reportable income. Now, there's also a lot of insurance strategies out there. Now, I'm not talking about whole life insurance or anything for death benefit, But a lot of wealthy individuals are using a life insurance wrapper, what I call a cellophane wrapper, around an investment portfolio. So usually you have 100% cash value the first year. It's diversified into many investments, and there's a very small charge for technically the insurance cost, because you have to have the wrapper in order to grow the money tax deferred. And because of insurance laws, you can take money out of it income tax free. So this strategy is being used by a lot of people in a Roth type setting, because Roth plans have limits. These strategies have no limits, but you have to be very careful. Don't look at this as buying a whole life policy to try to accumulate money for retirement. That's not what we're talking about. So these are very specially designed insurance arrangements that can grow the money tax deferred and pull that money out tax free in the future. And you don't have to pull it out. There's no penalties for age 59 and a half. There's no required minimum distributions. And that's the final surprise that Henry will be hit with. Today, 73, very shortly, it's going to be 75. The IRS says, look, I'm tired of you accumulating all this money in these tax-deferred buckets. I'm going to require you to take minimum distributions. And you have to take those distributions each year, even if you don't need the money. And there are a number of good tax strategies out there to show you how to redeploy that money from those RMD payments. Finally, we take a look at going back to the individual that was fortunate enough to put a lot of money away into that cash balance pension plan. So that cash balance pension plan now has a lot of money in it because you've got higher deductions going from now into retirement. And as I said earlier, you're going to ultimately have to pay the tax on it. However, there is a strategy where you can put an asset in your cash balance plan that has kind of a Roth type of conversion to it when you retire, and those dollars can flow below the bottom line. So if you currently have a cash balance plan or you're contemplating putting one in, you should look at the strategies on how to maximize the deductions going in, but how to minimize the tax on the other end coming out. Now, there is a number of strategies out there to minimize or eliminate taxes when you sell an appreciated asset. So personally, I've taken advantage of the first one, called a charitable remainder trust. Years ago, I sold a company to a New York Stock Exchange company, and I got a portion of the proceeds in their stock, and I got a good portion in cash that I paid my capital gains tax on. But the good news is, and the bad news is, their stock went up by 300%, and I had no basis in that stock. So I went to my CPA and I said, who was looking in his rearview mirror, I said, what do I do? He said, pay your capital gains tax. At the time I lived in California. I said, that's 20% federal and another 13.3. There's got to be a better strategy. So through my own work and working with subject matter experts, I developed a charitable remainder trust. Now, I wasn't philanthropic at the time. I wanted the deduction, and I wanted to take this money and use it in the future. So I took a portion of the stock and I made a contribution to a charitable remainder trust. And I had my own family foundation was set up to be the beneficiary. So I had nothing in the family foundation at the time. I simply set it up so that they would be the recipient of this charitable remainder trust. So I got a tax deduction for monies going into the CRT, and the CRT was able to sell the stock without paying any capital gains tax. Now this became a secured asset that was creditor protected. And based on my age and my spouse's age at the time, we were able to pull out 7.3% of principal and interest for the rest of our lives. Now you think about that. What a great retirement. So I don't pay any tax on all the accumulation. I didn't pay any tax on the sale of that asset. I've got creditor protection, and I'm able to pull out which I'm still enjoying today, 7.3% of principal and interest. So my portfolio goes up and down during the year. At the end of the year, we take a look at the balance and it calculates how much I'm going to take over the next 4 quarters from distribution. It's a strategy that can take an appreciated asset and minimize your taxes on the other end. Another strategy that a number of our subject matter experts are using to help with this appreciated asset is to use a charitable LLC. It's kind of similar to what Mark Zuckerberg did at Facebook with his shares, but it's similar to a charitable remainder trust, except the income that you're receiving is tax-free. And I can't, based on the time we have today, I can't get into all the details, but with hindsight, had I known about this way back then, I might have done the charitable LLC. But the key here is to look at all of the opportunities for minimizing your tax when you're selling an asset, selling your practice, having an appreciated asset. Maybe you got real estate. So a number of our physicians have invested in real estate, and they're so tired of doing these 1031 exchanges. So sometime in the future, you're going to get to the point where you're saying, look, I can't do a 1035 exchange because I need the money for retirement. You go to your CPA and they say, well, you have to pay your capital gains tax when you sell the building or sell the real estate investment. There are tax strategies to minimize or eliminate the tax on that distribution. So take a look at all these different strategies, from deferred sales trust, deferred comp, installment sales, et cetera. My message here is there are a lot of tax strategies that a lot of your CPAs are not thinking about because they're not tax specialists in the area. And again, I just hate paying taxes myself. And if there's a way that through the legal structure and that it's well documented in black and white that I can reduce and save taxes, I'm all in for that. So what I hope you learned today from this webinar is the first thing you need to do is think about not only diversifying your assets for accumulation, you need to diversify your tax strategy at the same time. You need to think about different buckets, from the tax deferred buckets to the taxable bucket to the non-taxable bucket. And you need to manage that. And you need to manage your income and taxation and retirement to keep your costs down, because you really need to be thinking about your longevity risk also. You know, a lot of people retiring today are concerned with outliving their money, running out of money because of longevity today. Again, there are good tax strategies for that. So as I mentioned at the onset, we're a partner with the American College of Emergency Physicians. On our website, myfinancialcoach.com, we have a lot of content in My Financial Coach, or MFC's university. Lots of ideas from student debt financing to minimizing your taxes to helping you figure out what corporate structure you should put together. If you have questions, you have my email there, wmacdonald@myfinancialcoach.com. You've got the logo that you can hit on the end and pull up the ACEP's offering to its members of the full financial planning service, or you can simply go to myfinancialcoach.com and that will pull up a special web page. You can see more about the financial planning process that we go through, and you can also click on a button there and set up a call with one of our CFPs to see if our financial planning makes sense. Now, a lot of physicians come to us early and say, I already have an advisor. And that's great. We're not there to take away your advisor. Chances are your advisor is probably managing money. Your advisor may be handling your insurance needs. Your advisor may be your CPA helping you with filing your income taxes. What our job is to be in the middle of that in a family office type of structure and help you get through this, help you coordinate all of those advisors. Because if you're a good wealth manager, chances are you may not have a lot of expertise in taxes. If you're great in taxes, chances are you're not a good manager of money. If you're a great insurance agent, Maybe you don't know much about property and casualty liability and malpractice. So we need to bring the team together for you. Again, go to myfinancialcoach.com and check us out. Thank you, and send me some questions.